Hello guys, welcome to my YouTube channel. Today we are going to discuss about ratios in the management of financial statements. And we have been given a question here which reads, the following is a summarized profit and loss account of XYZ Limited for the year ended 31st December 2018 on the balance sheet as at that date. The profit and loss account and the balance sheet have been given in the question. The question requires, using the above information, calculate the ratios categorized into the first category of ratios, that's the liquidity ratios. Liquidity ratios, there are different types of ratios. The first one is the current ratio. This is calculated as current assets divided by current liabilities. From our question, the current assets is 250,000 and the current liabilities is 130,000. This will give us a ratio of 1.92:1. That's the current ratio. The next type of liquidity ratio is the quick ratio. The quick ratio is calculated as the current ratio, but in the current assets we less inventories or stocks. The formula is current assets, you less inventory, then divide it by current liabilities. And from the question, the current assets is 250 and the inventory is 149,000. The current liabilities is 130,000. This gives a ratio of 0.78:1. The liquidity ratio are the two, the quick and the current ratio. The other category of ratios is the activity ratios. These ratios include the stock turnover ratio, which is calculated by dividing the cost of sales with the average stock. This average stock is the opening stock. You add the closing stock, then you divide by 2. From the question, the cost of sales is 510,000. The average stock will be the opening stock, which is 99,500. You add 149,000, then you divide by 2. This gives us a ratio of 4.1 times, since it's the turnover ratio. The other type of activity ratio is the debtors turnover. This is calculated by dividing credit sales with the average debtors. From the question, the credit sales was 80% of sales. This will be 80% of 850,000. This gives us 680,000. Then we divide by the average debtors. That's the debtors amount is 80,000. And this gives a ratio of 8.5 times. After the debtors turnover, we have the average collection period. This is the number of days in a year. We divide it by the debtors turnover ratio. This will be 365 days. We divide by 8.5 times. And this gives us 43 days. The other type of activity ratio is the creditors turnover. This is calculated by dividing the credit purchases with the average creditors. This will be 545 from the question to 50. We divide by the average creditors, that's 130,000. This gives us 4.2 times. The next one is the payable referral period. This is calculated by dividing the number of days in a year with the average creditors. With the creditors turnover ratio. This will be 365 days divided by the 4.2 times. This will give 87 days. The next type of ratio, with that type of ratios is the leverage ratio. In this category, we have the debt to asset ratio. And this is calculated by dividing the total liabilities with the total assets. From the question, the total liabilities is 230,000 divided by the total assets, that's 580. It gives a ratio of 0.4 or 40%. The second type of leverage ratio is the debt to equity ratio. This is calculated by dividing the total liabilities we divide it by total assets less liabilities. This will be 230,000 divide by 250, and this will be 0.66. The third type is the long-term debt ratio. This calculated by dividing term debt ratio is calculated by dividing the long-term liabilities. You divide it with the net assets. And from the equation, it's 100,000 divided by 580. This is the total assets minus total liabilities. The net assets. This will be 0.22. The next type is the interest coverage ratio. This calculated by the earnings before interest and tax. You add depreciation, then you divide it to the interest expense. And this will be 175,000. You divide it with 15,000. This gives 11.67 times. That's the end of the leverage ratios. The next category is the profitability ratios. The examples of profitability ratios are the gross profit margin, which is calculated by 340,000. You divide it with 850. And this gives a ratio of 0.4. The next type of profitability ratio is the operating margin. This is calculated by dividing the earnings before interest and tax with the sales. And this will be 165,000 from the equation divided by 850,000. This gives a ratio of 0.19. The other type of profitability ratio is the net profit margin. It's calculated by dividing the net profit after tax with the sales. This will be 75,000 divided to 850,000. It gives a ratio of 0.09. The other type is the next type is the return on capital employed. This is calculated by dividing the net income with the net assets. And this will be 75,000 divided to 450. This gives a ratio of 0.17. Lastly, we have the return on equity. And this is calculated by dividing the net income with the shareholders' equity. This will be 775,000. We divide it with 350,000. This gives a ratio of 0.21. And that's the end of our class. Thank you. See you next time.